Look at how fast inflation is rising. If this current trend continues, then we're going to be at around 4% inflation by late next year. That's a level that I would be concerned about because wage growth right now is 3.9. Consumers can handle inflation so long as their wages are outpacing inflation. If wage growth is outpacing consumer price growth, then real wage growth is positive and the consumers can handle that. But as soon as they start getting squeezed, so inflation starts outrunning wage growth, that's when you get worried. Wage growth right now is 3.9%. So assuming that stays the same, we're at 3.9% wage growth for the next 12 months, then within the next 12 months, or 12 months ish, inflation will outpace wage growth. If you do miss this next 2 year window and then things play out like they did after the dot-com crash, you're basically 15 years of no real forward progress. That's why it's so urgent to be AI with AI right now, to capitalize on a gold rush while the gold is still flowing. Because if you don't, history says afterwards the hangover is rough and it can last a very, very long time.
Hello and welcome to Being Exponential with Luke Lango, where we'll discuss the markets, the economy, technology, and lifestyle, all from an exponential perspective. It is September 2nd. I'm your host, Brooke. Let's dive right in. All right, Luke, I hope you had a good Labor Day weekend, but I want to get cracking on possibly a downer of a topic. So last week we did discuss the AI markets and the Fed cutting rates and how that could potentially lead to a long-term headwind. But I want to start this week off by discussing the potential for a dot-com style crash in the AI market. Recently, earnings came out for a lot of companies. A lot of them did fantastic. However, over the past week, we've noticed a dip, or more than the past week, in several AI stocks, so specifically Palantir, MP Materials, Robinhood, Celestica, and the list goes on. Even Nvidia, what you can call the flagship for AI stocks. And it is quite concerning that in the face of positive earnings, we're seeing dips in these stocks, and it could be a sign of things to come. We even have Sam Altman saying there is the potential or an AI bubble is happening. Now, I do want to get your take on this information, Luke. What do you think?
Yeah, I mean, I think we've made it abundantly clear in these podcasts that the AI boom will eventually and inevitably turn into an AI bust. That's just how these things happen. That is the law of modern capitalism. The cycle is boom, bust, boom. It's not boom, boom, boom. There's no such thing as boom, boom, boom. There's no such thing as booming forever. Every boom eventually and inevitably turns into a bust. So I hope we've been abundantly clear in saying that yes, this AI boom will eventually turn into an AI bust, but the question is about timing. Timing is everything because as we've shown you before, the best part of the party is the last hour. The best part of a basketball game is the fourth quarter. The best part of a baseball game is the eighth and ninth inning. That's when things get really interesting. That's when things get really fun. Well, in the stock market, the best part of a rally is the last few quarters. That's when you typically see the biggest gains, the most parabolic gains, the most euphoria in the markets. I mean, we've shown you this chart before, pulling it up right now, graphing tech stocks here in the 2020s post launch of ChatGPT versus tech stocks in the 1990s post the launch of Netscape in late 1994. Orange line is current, yellow line is the 90s. They track each other almost perfectly. And as you can see from that, the best part of the dot-com boom happened in this second half of the boom. I mean, the index absolutely soared, especially here in 1999. This is the best year ever for tech stocks. So just because I think the AI boom will eventually turn into an AI bust does not mean I think you need to get out of the AI boom. Rather, you just need to make as much money as possible while the boom is still alive and well, but listen for when the music stops playing and find a chair. Right now, I hear the music playing loud and clear. There are a lot of things that I do not like that are happening on the macroeconomic front as well as the geopolitical front. I think those things eventually will become big enough to derail this rally, but we're not there yet. What we are seeing on the macroeconomic and geopolitical fronts in terms of headwinds are slow burners. We have slow moving headwinds that are still pretty small. If they get left unchecked, then they will become faster moving headwinds that are big enough to derail the rally. But we are not there yet. What am I talking about there? So, what I'm talking about there is going to be one, inflation.
Right.
Tariffs are causing reinflation. The data there is inarguable. Tariffs launched in April, and in every month since then, both CPI and PCE, headline and core inflation, have risen every single month. What I just pulled up for you is PCE and core PCE, because that's the Fed's preferred inflation metric. That went up in May, that went up in June, that went up in July. It's going to go up in August again based on real time estimates. As you can see, though, on this chart, it's not much of a rise, right? I mean, what we've gone from 2.2 on headline to 2.6, going to creep up to 2.74 next month. So 2.2 to 2.75, 2.8. That's not a lot, and we're still below 3%. You look at core, we the trough there was what, 2.6 in April. Now we're at 2.877. We're going to go to 2.95 next month, so 2.6 to 3%. That's not a lot of reinflation, still generally below 3%. So this is what I mean by, yeah, this is a headwind that is brewing, but it's slow burning and it's small in magnitude. And inflation going up 10 to 20 basis points a month, staying below 3%, that's not enough to really derail what is still a massive AI tailwind powering this market. Another thing that I'm concerned about, 30-year treasury yield. Okay. Everyone wants to talk about the Fed cutting rates and it, reducing financing rates and just unlocking a lot of capital in the economy. And it could in a lot of places, but there's short-term financing rates and then there's long-term financing rates. Short-term financing rates, 2-year, 5-year, 7-year loans, a lot of auto stuff, a lot of business loans sometimes. Yeah, that can get unlocked dramatically because that's based off of, a 2-year treasury yield, a 5-year treasury yield, a 7-year treasury yield. Those are falling. Those are influenced a lot primarily by the Fed and them setting interest rates. But when you look at the long end of the curve, when you look at the 10-year yield, when you look at the 20-year yield, when you look at the 30-year yield, those are less influenced by the Fed. They are more influenced by macro factors like reinflation, like deficit concerns, like stuff akin to that. And that's why when you look at the long end of the curve, we are not falling on the long end of the curve. This is the 30-year treasury yield, and it is pretty much at cycle highs. It kind of topped out right just above 5% back in 23, came down, and now I've been making a series of higher lows back to that 5% level. The 30-year yield is at 5%. It is not moving lower, even though the market is pricing in a rate cut in September and 5 rate cuts between September 25 and September 26. With that pricing, we have seen the 2-year yield fall dramatically. We have not seen any budge in the 30-year yield. So that worries me because what is a 30-year loan? A mortgage. That's the most important loan out there. The most important rate out there, the mortgage rate. Most of them are 30-year mortgages. Most of them are based off of this 30-year treasury yield. I'm a little bit concerned about that. But again, we're not breaking above 5%. We're kind of plateauing right at that 5% level. So again, something to be concerned about, but not something that's big enough to really derail the rally, especially given the fall in short-term financing rates. Another thing I'm worried about, the way people are looking at just the employment picture. Okay, the employment picture is deteriorating very, very rapidly. The chart I just pulled up right here is the sum of the ISM Manufacturing Employment Index and the ISM Services Employment Index. So what companies in the manufacturing sector are saying about employment trends, what companies in the services sector are saying about employment trends, add those two up. This is the sum result. Right now, that index is 89.8. As you can see from this chart going all the way back to the late 1990s, readings below 90 only happen during recessions, right? COVID, big drop below 90. Great financial crisis, big drop below 90. The dot-com crash, big drop below 90. Outside of those times, we don't drop below 90 on this index. We just don't. But yet here we are, 89.8. We're below 90. So businesses feel really crappy about the employment picture right now, and they're not alone. Consumers feel the same way. This is the University of Michigan's expected change in employment over the next year. So University of Michigan, big consumer sentiment index, they go out and ask everybody, hey, how are you feeling about jobs over the next year? Do you think employment's going to, or unemployment's going to rise, or it's going to fall over the next year? We're at 52. So 52% of people think that unemployment is going to rise in the next year, or going to fall in the next year. Again, that's a level reserved for recessions. We only get this low. The employment index in that survey only gets this low. Great financial crisis, dot-com crash, early 90s recession. Outside of those times, we don't see readings this low, yet here we are. And then more broadly on just the whole consumer sentiment picture, the consumer sentiment backdrop. University of Michigan, the headline consumer sentiment index, we are at 58.2 on that right now. As you can see in this second panel here, that's a very, very, very low reading, below 60. Again, below 60 only tends to happen when the market is in pain. So like right here back in the early 80s, right? We were down around 65, 64. At that point in time, the market was in the middle of a 25% crash. Here in the early 90s, down at 64, 63, the market was in the midst of a 15% crash. Great financial crisis, we dropped below 60 a few times in the middle of a 50% crash. 2011 debt crisis, below 60, we were in the middle of a 17% crash. Obviously, the inflation crash of 2022, we got to 50 on that. We were in the midst of a 25% crash on the S&P. Yet here we are, again below 60, and the market's at all-time highs. So these are all the yellow flags that I'm monitoring. We can't have consumer sentiment stay this low for this long without the market giving back something, or else consumer sentiment has to rebound very rapidly. We can't have mortgage rates at the long end of the curve, not mortgage rates, all financing rates at the long end of the curve, the 10-year, the 15-year, the 20-year, the 30-year treasury yields stay this high and not exert negative pressure on the economy. We can't have the economic data, the inflation data be this hot, the economic data be this troubling to support the market continuing to go higher for a lot longer. So these are the yellow flags, again, that I'm monitoring. I do not believe that any of them are big enough or moving quickly enough to overnight derail the AI bull market, because we still have a ton of strength there. To your point, the earnings over the last several weeks, several months have been superb. If we pull up a chart of the S&P 500 earnings estimates, blue line versus the white line is the price. You can see white line falls, blue line falls, right? Stock price declines tend to coincide with a melting of EPS estimates. We're not seeing that. This blue line keeps pushing higher. EPS estimates are still strong. So there's still a massive undercurrent of growth right now, but there are a lot of yellow flags popping out that we need to be aware of and we need to keep monitoring, because I think eventually those yellow flags, those risks will get big enough, move quickly enough to derail the bull market. I'm giving it 12 to 24 months runway. I definitely don't think it happens within the next 12 months. It might happen after that. But I think we got another 12 to 24 months runway of fabulous gains for the market. And then we got to pay the piper. And these risks become a real big problem. So no, I don't think the big AI crash has come. But I do think that we are starting to see the breadcrumbs, if you will, or the beginning stages of what could cause the crash in the next 1 to 2 years.
Gotcha, Luke. Much fascinating information there. Now, before I move on to my next question or the next topic here, I am curious about the way we view time in the markets now. Correct me if I'm wrong, but over the past maybe 5 to 10 years, the market itself has become more volatile because of the nature of technology and communication. And then with the confluence of all these other factors, is it safe to say that that timeline could be truncated just because the market itself is more volatile? Is that something
Yeah,
we should be concerned
I
about?
would go back to this. I'd go back to this chart, right? I'd go back to this one that's comparing AI stocks in this 2020s boom versus internet stocks in the 1990s boom. According to this analog, we have another what, 2.5 years basically. I don't think we have another 2.5 years this time. I do think things are happening more rapidly. I don't think this plays out fully like this. Instead, I think 1999, this style surge happens now, and then we pop out. I would start to get really worried about these things in late 26, early 27. I think one of the things I am watching is, okay, if you look at how fast inflation is rising, go back to this PCE chart. Look at how fast inflation is rising. If this current trend continues, then we're going to be at around 4% inflation by late next year. That's a level that I would be concerned about because wage growth right now is 3.9. Consumers can handle inflation so long as their wages are outpacing inflation. If wage growth is outpacing consumer price growth, then real wage growth is positive and the consumers can handle that. But as soon as they start getting squeezed, so inflation starts outrunning wage growth, that's when you get worried. Wage growth right now is 3.9%. So assuming that stays the same, we're at 3.9% wage growth for the next 12 months, then within the next 12 months, or 12 months ish, inflation will outpace wage growth. That's when the yellow flag becomes not a red flag, but a much bigger yellow flag on the inflation front. And then you have all this other stuff, right, with the geopolitical chaos of the tariffs and the National Guard deployments, and now it's all getting uh, worked out in courts. And I mean, because you had the International Trade Court ruling that the vast majority of tariffs were illegal, then it got sent to an appeals court, and an appeals court on Friday said that they were indeed illegal. So now that's going to get kicked up to the Supreme Court. Now the Supreme Court's not going to rule against them because they have a 6-3
Right.
conservative majority up there. And so the tariffs will stay in place. But nonetheless, it creates a bunch of geopolitical chaos. And it's this on again, off again tariff environment. And nobody can really plan or schedule for that. And we saw that in today. So today's Tuesday, September 2nd, 2025. We got the August ISM manufacturing report this morning. And the headline numbers weren't awful, but the commentary was absolutely horrendous. And actually, I pulled it up here because I want to read you a couple quotes. So, with the ISM manufacturing report, what they do is they obviously release all the numbers, but they also include commentary. So each month they have 10 comments from businesses that they kind of post randomly. This is what businesses are saying about business activity this month. This month in the August report, all 10 of those comments were sharply negative. All 10 of them, 100% of the comments posted were negative. Let me just read you like some tidbits from that, 'cause it's pretty shocking what some companies are saying right now. A company in the food sector, a 50% tariff on imports from Brazil means certified organic cane sugar and everything made with it is about to get significantly more expensive. Another company, tariffs continue to wreak havoc on planning and scheduling activities. A company in the trucking industry, this one is pretty scary. The trucking industry continues to contract. This current environment is much worse than the Great Recession of 2008, 2009. There is absolutely no activity in the transportation equipment industry. That same company said we are also in stagflation. Prices are up due to material tariffs, but volume is way off. So they go on and on and on and on and on. The through line here is very clear. Tariffs are driving up costs, they're destabilizing supply chains, and they're eroding both domestic and international demand. Again, not big enough of a concern today to derail the rally. But if that commentary gets incrementally worse month by month over the next 12 months, then yes, we are going to have a real big problem on our hands. So I am watching all that stuff very clearly now, or very closely. Now, I am very bullish on all the developments we are seeing in artificial intelligence. I love it. AI moving to the edge. I love AI getting physical. I love AI, the LLM advancements we're seeing. I think all that stuff is fantastic. I think the earnings reports show there's a lot of great progress right now. But as we saw in the dot-com boom and bust, there were fantastic internet developments happening throughout the early 2000s that did not stop the stock market from crashing. That did not stop internet stocks from broadly losing 80% of their value. That did not stop Amazon stock from losing 95% of its value. So you can simultaneously, and I think Sam Altman is kind of in the same boat that I am right now, you can simultaneously be really, really bullish on the long term future of artificial intelligence and its potential impact on our economy and society to be super, super positive and create a society of abundance and a lot of growth in the long run, but also be bearish in the short run about maybe things are a little bit too frothy right now. People are too excited. People are getting ascribing too large evaluations to too small of projects, and there's going to be a great concentration in the AI sector just to the winners, and they're going to slim down the industry dramatically. So that's where I'm at. I'm simultaneously very excited long term about all of these things, but in the short term, again, I think we have 12 to 24 months runway, fantastic bull market ahead. But I do think that we are going to have to pay the piper, and we're going to have to pay them because of tariffs. We're going to have to pay them because of reinflation. We're going to have to pay them because rates aren't going to go down in the way that a lot of people want them to go down. And that's all going to come together, I think, in late 26, early 27 to create a lot of pain in markets for maybe a few years.
Got it. Yeah, it seems like a lot of external gunk in the proverbial wheel in terms of the market.
Mhm.
However, I do want to come back to those earnings, and specifically, I want to focus on Nvidia, and then a couple of others I want to touch
Yeah.
base on. But Nvidia, the first company to ever hit $4 trillion in market cap value, uh, essentially integral to the American economy at this point because it's so large. And it had essentially a stellar earnings report. It only missed on, I believe, data center revenue and another option. However, the stock dipped about 2 or 3% after earnings came out. Now, some could say that was people profit taking. However, it just kind of ties back into what we are talking about maybe an impending or upcoming AI crash. What's your take on Nvidia specifically? And then I also want to talk about a couple of other AI stocks as well there.
Yeah, I think the Nvidia earnings report and subsequent price reaction speaks to what we just talked about. That one, the numbers themselves confirm that the AI boom is not slowing down at all. I mean, we got what revenues up 56% year over year. Data center revenue, which is the heart of the AI build out, all that AI revenue, also up 56% year over year. The guide calls for 55% revenue growth next year, up 15 to 16% quarter over quarter. And that excludes any China sales. I think there's about $2 to $5 billion in China sales there. So if you throw back in those China sales, which is again not a demand thing, it's a regulation thing. If you throw that back in, then you're looking at 60 to 70% revenue growth for next quarter. So either way you look at it, with or without China sales, the AI growth story at Nvidia is not slowing down. Then Jensen Huang's out here saying he expects $4 trillion, $3 to $4 trillion in AI capex over the next 4 years. So that's about, at the high end, $1 trillion per year. So there was a lot of really good stuff in that report and in the conference call, a lot of bullish sentiment, a lot of bullish numbers. Yet, yeah, look at the stock. It fell that day, kept falling the next day. It's fallen on Tuesday. It's on a losing streak ever since that report. That is a microcosm of what we just talked about. There is simultaneously a lot of good stuff going on in AI right now. You had a lot of worries about, okay, how long can this last for? Now, in the case of Nvidia, I do think they're going to sustain. Well, I think the stock's a great valuation here. Okay. I think they're going to sustain probably 20 to 30% revenue growth over the next 2 years, 2 to 3 years, probably 30% ish, maybe a little bit over 30% EBITDA growth compounded over the next 2 to 3 years. And the stock's trading at 25 times forward earnings. So to me, that is a really attractive valuation setup for Nvidia. I think Nvidia stock does have a lot of runway here. I'd be a buyer on this dip. I think it's a fantastic long-term holding, so long as the AI boom remains alive and well. And I think, again, we have total 24 months runway there. I think Nvidia stock will be a leader. I think the stock will bounce back. I think it'll rise significantly over the next 12 to 24 months. I view it as the Qualcomm of this era. Qualcomm was the big, chip stock, the big supplier stock of the internet build out in the late 1990s. That stock rallied all the way till the bubble burst. And in that last year of the bubble, 1999, Qualcomm had a heck of a year, a gangbusters year, a blockbuster year. And I think Nvidia will have a blockbuster year over the next 12 months or even longer. So I'd be a buyer on weakness here. I think the report was really good. But yeah, the subsequent price action does speak to I'm not the only one out there thinking that, yeah, these risks are building and we got to be aware of them. We don't have to give in to panic, but we have to acknowledge their existence. And in acknowledging their existence, that creates some selling pressure. So that's why Nvidia stock, despite a blowout report with a great guide, has been dropping ever since. But again, I'd be a buyer on that dip.
Definitely. Okay. And then I just want to hit a couple of quick companies here and get your take on
Sure.
those. First off, CrowdStrike.
Yeah, CrowdStrike, cybersecurity. I love this stock. I love this company. Again, so what we kind of just talked about is looking out over the next 3 to 5 years, potential for a big final leg higher in this bull market and then a bust thereafter. What we're going to talk about now with these earnings, I'm going to look at it from the perspective, okay, how are these stocks or companies going to do over the next 12 to 24 months as long as this AI boom remains alive and well? So in that context, looking at the 12 to 24 month window, CrowdStrike. I think it's a great play for the next 12 to 24 months. Again, the bull thesis on all cyber AI right now is twofold. One, as companies adopt more AI applications and they proliferate across their enterprises, that means more data just kind of floating around everywhere. So the surface area of data, of critical sensitive data in an enterprise increases in the age of AI. So that means I'm going to need more cybersecurity products to protect that bigger surface area. Number two is now hackers have AI, right? So you got this biggest surface area, this bigger surface area of data, and now it's being attacked by much more sophisticated and potent AI powered hacking tools. So you need AI powered defenses to protect this bigger surface area of data. So you kind of have this dual tailwind going on for the entire cyber industry right now. CrowdStrike's numbers prove that they are a beneficiary of that. I mean, their report was a clean double beat and raise. The big thing is that they reported their first accelerating quarter of revenue growth since early 2024. Revenues rose 21%. Next quarter, they're expected to rise 20%. In the fourth quarter, they're expected to rise 22%. So this was a slowing revenue growth story for a while. Now, all of a sudden, it's a re-accelerating revenue growth story. Love to see that. Margins are expanding. I think you got to probably a 20% revenue grower here, 30% profit grower. It is expensive at over 100 times forward earnings, but you pay that premium for cyber because demand is considered more durable. I think it's a winner. I think this is a company that's proving itself to be a winner in the age of AI, with cyber creating more demand for cybersecurity solutions as well as AI powered cybersecurity solutions. CrowdStrike to me is a winner. That was a stock. That is a stock I would be a buyer of over the next 12 to 24 months.
Got it. And next up, Snowflake.
Snowflake. Yeah, so Snowflake again, I'm going to throw it in that CrowdStrike basket. I think it's also turning into a winner, an age of AI winner. I think next 12, 24 months, you got a good outlook on that stock. The story there is that, again, more AI apps, more data. Companies need to manage that data, not just protect that data, but manage that data. Snowflake is providing the data basing layer for AI applications. So company adopts more AI applications, they have more data, they need to manage that data. They tap Snowflake and Snowflake services to manage all that data, to host all that data. So Snowflake is turning into a very critical data basing solutions provider to power enterprise AI applications. And the numbers they reported last week, I do believe, confirm that they are winning in this trend. Going over their numbers, that was also a double beat and raise report. They also reported their first accelerating revenue growth quarter since early 2024. That is a theme for companies that are emerging as AI winners. All of a sudden, slowing growth is turning into re-accelerating growth. Revenues rose 32%. The third quarter, revenues are expected to rise about 25%. In the fourth quarter, revenues are expected to rise about 25%. Again, assuming they beat that guide, which they normally do beat their guide, you're looking at what, 27, 28, 29%, maybe 30% revenue growth the rest of the year. So there's a 30% compounded grower. That's really, really impressive. Operating margins up 600 basis points in the quarter, EBITDA up 105%. So not only are you getting this re-accelerating top line growth narrative, but you're coupling that with very robust margin expansion, creating triple digit profit profit growth, and you got the stock trading at, I mean, 163 times forward earnings. That's expensive, but again, for a company that's emerging as a winner in the age of AI with triple-digit EBITDA growth, I think the stock's in breakout mode. I think this is a good stock to be buying. I think this is one that does go higher over the next 12 to 24 months, or for as long as this AI boom lives and breathes.
Yeah, just more reinforcement for that AI boom. Uh,
Yes.
Next up, Nutanix. Am I saying that right?
Yeah, so Nutanix is kind of a cloud software solutions provider for data centers. This was a big grower, but I think what we're seeing is it's slowing down a little bit, and I'm not really sure why it's slowing down. I tried to go through the call, I tried to pick it out. It was tough for me to really identify why their growth rates aren't accelerating in the way some of these other companies are. The Q4 revenues, what they rose 19%, but next quarter they're expected to rise 14%, and for the next year they're expected to rise 15%. So, I mean, there is stability in the mid-teens, but it's definitely a slowdown from the kind of 20% growth we have been seeing. So that's a little concerning. Maybe it's a tough lap, bigger base. Operating margins are expanding. EPS is ripping higher. The valuation is pretty attractive. So I think this one's okay. But when I look at kind of what's being reported right now, again, I think gains in the AI sector are going to continue to narrow. So you want to focus on the stocks and the companies that are really putting up good numbers and really winning. Snowflake is that. CrowdStrike is that. Nutanix is that to a lesser extent. I'm not throwing it in the basket of, get rid of the stock. It's not a winner in the AI era, but I'm definitely not putting it in the basket of, wow, this company's absolutely firing on all cylinders and the stock's red hot. So jump on it. It's kind of in between, stuck in no man's land, if you will, right now.
Okay. Another company, Dell.
Dell is a story of it's a tug of war between their AI growth and their AI cost. So, long story short, is what's driving their growth right now. I mean, the company is reaccelerating growth dramatically. They just reported 19% revenue growth in that quarter. Next quarter guide, 11% growth. Fourth quarter guide, 12% growth. So, we're finally turning into a durable double-digit revenue grower here. This is a company that could not break 10% revenue growth for years and years and years and years and years. It was a single-digit grower. Now we're finally okay. Every quarter, we're going to get double digit revenue growth from them. That's because of AI servers. They're shipping a lot of AI servers out there. All the businesses AI servers right now. So they're winning in that AI server race. That sounds fantastic, but the problem is that these AI servers come with higher costs because they're already so marked up. They have very expensive parts like Nvidia GPUs and accelerators and stuff like that. Those things are already so expensive that when Dell buys them at the super high cost, they can't really mark them up a bunch and go sell them to customers. So the markup that they're getting on AI servers is much smaller than the markup they were getting on classical servers. And so because of that, the margins over at Dell are compressing. You are seeing gross margins come in every single quarter, and management is saying, hey, that's probably going to continue. So you have a tug of war between, again, accelerating AI growth, but also rising AI costs. Now, eventually, I think the AI growth side of it outweighs the AI cost side of it because I think that the premiums that Nvidia is charging and all that that's going to go down. So then the markup for Dell is going to get bigger and margins will come back. So I think that's going to work out well. But again, this is more in the Nutanix basket than it is in the Snowflake or CrowdStrike basket. You want to find the companies and stocks that are really just blowing it out of the water right now and stick with those as opposed to finding ones that are kind of doing well, but kind of not doing well. So Dell to me kind of stuck in no man's land, but leaning bullish because valuation is cheap, AI growth is strong, and I think these AI cost headwinds will fade gradually, not overnight, but fade gradually over the next few quarters.
That's interesting. That kind of mirrors the Nvidia issue with the Blackwell series, the high cost of these AI specific goods versus what they can mark up for them. That squeezing of that margin.
Yeah, I mean that's exactly right. Like this is another potential yellow flag, right? That again, it's not a problem right now because these companies are reporting such huge growth. But when growth slows, if costs do not come down, then you have a margin squeeze issue. Dell is seeing that a little bit. Will Nvidia see it? Maybe. I mean, you could nitpick that report and say one of the things that was wrong with the Nvidia report was the gross margin guide. So you could nitpick it to that extent. So from that perspective, again, that's just another yellow flag to be waving right now. It's not big because even with that, weakish gross margin guide, we're still looking at 30 to 40% compounded
Yeah.
profit growth, EBITDA growth, EPS growth, both over at Nvidia. But again, the problem is if the top line growth rates slow, and they probably will because of law of large numbers, and the cost growth rates don't moderate, and you get a margin squeeze, and all of a sudden 30-40% profit growth turns into sub 10% profit growth, and that's when these stocks can fall off a cliff. Now again, that's not going to happen in the next few quarters, probably won't happen in the next 12 months, but it could happen if inflation really picks up back to 4%, consumers stop spending, long-term rates don't come down, enterprises don't unlock that extra capital. There are risks that are rising, which could really threaten margins, corporate profit margins, over the next 1 to 2 years. So again, another yellow flag to be waving right now.
Got it. Okay. I just want to bring out four more companies really quickly here, starting with
Okay.
Pure Storage.
Pure Storage. Okay, we'll do this one quickly. Great report last week, but the big story is that the bull thesis here is that companies are going to switch to flash storage for AI applications, and companies being hyperscalers, the big dogs, the big AI firms, and they are. Meta is doing that. So Meta has switched to Pure Storage, or at least is a Pure Storage customer now, and they're ramping into volume deployments of Pure Storage. That's probably the first of what will be multiple wins for Pure Storage at the hyperscale level. I think this is one that I put in the CrowdStrike Snowflake basket. I think it is firing on all cylinders right now. I think growth will accelerate over the next few quarters. I think the stock will push higher like that one.
Gotcha. And then Marvell.
Marvell got absolutely clobbered last week. I still like the stock a lot because I think they are the backbone of custom silicon development. I think all the big tech companies, well, I know all the big tech companies are trying to make custom AI chips. Their progress has been lumpy. That's why Marvell's results have been lumpy. But I think this is a long-term story. I think over the next 5 to 10 years, beyond the boom bust cycle, I think that these companies are going to successfully ramp production, volume production of their own custom AI chips, and that Marvell is going to be one of the not one of the going to be the most critical enabler of that custom IP. So I think the long-term story on Marvell is really, really attractive. If you have a long-term time horizon, I'd be a buyer of weakness in Marvell stock. I think this one is going to be one of the biggest long-term winners on the chip side of the AI boom.
Fascinating. Okay. Next up, Autodesk.
Autodesk, CrowdStrike, Snowflake basket. Double beat and raise report last week. Let me get the exact numbers here. Yeah, double beat and raise. Revenues up 17%, third quarter guide up 15%, fourth quarter guide up 13%, operating margins of 39%, up 180 basis points year over year, EPS up 22%. Real strong growth here. Two tailwinds. One, they're getting a boost from the AI data center build out because you go out and you build an AI data center, that's construction activity, that's building activity. Those firms are increasingly tapping Autodesk for their AEC software to kind of manage those build out. So they're winning at that level. And then they're winning at the deployment level, the application level, because they have all of these new AI products they're launching that are driving accelerating growth, bigger contracts, more revenue per customer. So they're kind of winning at both the infrastructure and application layer at the same time. This is a company that's really proving out its strengths in the AI boom. The stock to me is still pretty undervalued. I think I got it around 27 times forward earnings. I see it as a probably 20%, even 25% profit grower. That's a pretty attractive valuation setup. I do like the stock here.
Got it. And then finally, Ambarella.
Oh, Ambarella. We've talked about Ambarella quite a bit on this podcast as a physical AI pick, as an edge AI pick. Vision chips, right? We think that vision chips are going to be huge when it comes to edge AI. And that's what their report showed. Ambarella reported what Double Beat and Raise report. The big thing was that they hiked their their revenue guide for the full year from I think it was about 20% to over 30% revenue growth. So massive, massive growth here. What's driving the big hike? Well, strong secular growth in edge AI, four verticals: portable video, robotics, drones, autonomous drones, and edge infrastructure. So Ambarella, I've long liked this as a edge AI pick, the picks and shovel supplier for AI as it moves to the edge, for AI as it goes physical. That report kind of confirmed that bull thesis to me. So I'd stick with this winner, throw it in that Snowflake and CrowdStrike basket.
Awesome. Okay. So now I want to pivot this conversation into something else that came up pretty recently. So what it feels like is almost a divergence from not quite reality, but a divergence from what we're seeing in the real world. These AI stocks and their reports, their earnings are amazing. But this report came out of Stanford, a study that indicated what we have been talking about, that AI is taking jobs. They highlighted in the 22 to 25 young employment range, those jobs are being taken by AI, a 13% dip. Now, let's discuss this, Luke, see what we can take from that paper, and then, how it is telling the story that we have been talking about.
Yeah, that paper put numerical evidence behind our thesis that we've discussed in this podcast that AI is indeed taking jobs, right? I mean, I just pulled up the key findings from that survey. We should throw a link for folks watching this
100%.
podcast to the actual paper. But the key findings from it were that one, since the widespread adoption of Gen AI technologies, early career workers aged 22 to 25 in the most AI exposed occupations have experienced a 13% relative decline in employment. Number two, employment for software developers aged 22 to 25 declined by nearly 20% from late 22 to July 2025. Customer service agents showed a similar pattern, 20% drop in employment from late 2022, launch of ChatGPT, to today. Number three, employment growth for young and old workers is generally healthy and stable in less AI exposed jobs. Nearly all labor market weakness since late 2022 has been driven by AI job losses. We talked about this when we discussed the jobs report, the July jobs report. A few weeks ago. Everyone, oh, it's tariffs, oh, it's political, oh, it's this. We said, no, it's AI. This study confirms it is AI. AI is causing labor market weakness, not tariffs, not politics, not other stuff. It is AI. Now, the fourth, and this is the big one, this is the society ripping finding. The benefits of AI are being hoarded by those who keep their jobs. While AI driven job loss has spread, wage growth for those still in jobs has remained healthy and strong, indicating a growing divide between those benefiting from AI and those being replaced by AI. We've said before in this podcast that AI is going to represent the biggest shift in wealth from the labor class to the capital class. This report says that shift is already happening. Microcosm of that, Salesforce. I just read a Fortune 500 article. I can pull it up here for you, or Fortune article, sorry, not Fortune 500, a Fortune article. Billionaire CEO Mark Benioff, the CEO of Salesforce, said that his $248 billion firm, Salesforce, has cut about 4,000 customer service roles as AI agents step in to do the work. They went from 9,000 customer service people to 5,000 customer service people. So according to him, they've chopped 4,000 jobs out of their customer service department. Now, let's assume that happened since late 2022, since the launch of ChatGPT. The labor class has lost 4,000 jobs. What about the capital class? Well, Salesforce stock is up about 100% since then, and it's added about $110 billion in market cap. It's gone from, here's the delta, from $128 billion market cap in late 2022 to a $238 billion market cap here in September of 2025. So you look at the Salesforce story, labor class is down 4,000 jobs, capital class is up $100 billion. That's the divide. That's the society ripping divide that AI is presenting to us right now. We warned people about it a month ago. We've been warning people about it actually all year long, but we warned people about it in this podcast about a month ago after that really nasty July jobs report. This Stanford paper, really hard hitting, shows that, hey, this is actually what is happening. Look at the Salesforce data too. Labor class down 4,000 jobs, capital class up $100 billion in value. Brooke, the AI jobs apocalypse has arrived. It is having a real and significant impact on both the labor and capital classes. It is going to accelerate and accelerate and accelerate, and it is going to mean a massive loss of wealth, influence, and power amongst the labor class, while creating a lot more wealth, influence, and power for the capital class. I don't know what segments of the labor class are safe. We've kind of talked about how do you kind of proof yourself against AI? How do you future proof yourself against AI encroachment? And we offered some ideas, but frankly, I don't really know. I mean, I'm talking out my ass for all I know, right? I mean, AI is advancing so rapidly. It is advancing so rapidly. It is becoming so much more capable, literally day by day, that I mean, if this advancement continues at the rate that it's going, what is going to be safe in a year, in 2 years, in 3 years? I'm not really sure. And so the only thing I am sure of is that the result of this, the outcome of this, is going to be labor class destruction of wealth, capital class creation of wealth. So if you're not sure where the labor class destruction ends, you might be in the firing range. We might all be in the fire. I'm in the firing range for sure. I'm in the firing range, and so I think the best way to hedge against risk of labor class loss, wealth loss, is to really pile into the capital class. The capital class is going to keep getting richer, so you might as well join them. If you can't beat them, join them, and that's been my motto to everybody. That's what I'm saying. AI with AI, all in with artificial intelligence stocks. Now again, I think the boom turns into a bust in the next, 2 years or so. But in that time, I think so much money can and will be made by the capital class that you have to be AI with AI. You have to buy the dip in stocks like Nvidia. You have to concentrate your portfolio around these AI winners. You have to go in with names like CrowdStrike and Snowflake and Ambarella that are really proving to be winners. There is so much wealth being created in the capital class by AI stocks, and yet the labor class is just losing jobs and losing jobs and losing jobs. And that's why all these consumer sentiment reports are so damn shitty. Excuse my language. I know I've cursed twice now in the last 10 minutes after not cursing at all in the first 20, 30 minutes of this podcast, but it's because I'm really passionate about it. And I really want people to understand this message. Why is the consumer class so miserable right now? Because they're not invested in stocks. What's the stat? Like the upper 10% of Americans own 90% of stocks. I think that's the like general idea out there. Okay, the upper 10%, they're doing fine. They're happy. Their 401ks are going through the roof. They own lots of Nvidia. They own millions in Nvidia stock. They're making money hand over fist. Meanwhile, the rest of us living paycheck to paycheck. We don't have, after, all the inflation and everything and the cost of living and our rents and our foods and our groceries and all that. There's $100 left over to put in the market. That's not going to do us any good. And so that's why consumers are feeling so crappy. Look at this chart. Consumer sentiment. We've never had an instant in the history of this survey, going back to 1980, we've never had a moment in time where stocks are at all-time highs and consumer sentiment is below 60. It's at recession levels in the markets at all-time highs. That's never happened before. And it's because of AI. Because AI is destroying the bottom panel, everyday Americans, and creating so much wealth for the top panel, which is not everyday Americans. So that's why I keep telling people, man, I'm pounding the table on it. You have to join the capital class. You have to get in with AI stocks. Yes, the party's not going to last forever, but as long as it does last, it's going to create a lot of money. At least I think it will. And so you might as well join the party. Don't sit this one out. Really do not sit it out because time out. Let's play this out. Let's say I'm right about this. Let's say the AI boom goes on for another 2 years, and then we get a dot-com style crash. The dot-com style crash wiped out 80 Nasdaq dropped 80% over the course of 3 years. And then it didn't recover its dot-com highs for 15 years. So if we play this out, let's just say, right, it's 2025 right now. We have another 2 years. Now it's the end of 2027. Okay, so much money's been made between summer 25 to summer 27. Then we crash 80% from summer 27 to summer 2030. Then it takes us another 12 years to get back to where we were at summer 27. So now we're at summer of 2042. I don't mean to be morbid, but how many of us are going to be alive by summer of 2042? Like, life is not guaranteed, right? Every day is a blessing. So why are we, if you do miss this next 2 year window and then things play out like they did after the dot-com crash, you're basically 15 years of no real forward progress. That's why it's so urgent to be AI with AI right now, to capitalize on a gold rush while the gold is still flowing. Because if you don't, history says afterwards the hangover is rough and it can last a very, very long time. So, anyways, that's my very impassioned spill about this whole AI jobs apocalypse thing.
I gotcha. I mean, I feel like I have to paint the picture in a negative way regarding, the unemployment rates and the younger folks that we were talking about. Imagine you're just coming out of college, you're six figures in debt for your computer science degree because over the past 10 years, everybody's saying you got to get into computer science, you got to get into computer science. And now your job's taken, so you're in six figures of debt. There's no jobs in your future, and there won't be. It's a really ugly picture that's being painted right now for a small group of people, but that group is only going to grow based on everything we've been talking about.
Yeah, I think it's a really, I mean, there's a lot of implications and ways to dissect this. One of which is what I just said, which is okay, given this backdrop, you really got to go all in with AI stocks over the next, 1 to 2 years, maybe up to 3 years, and make as much money as you possibly can during that boom. I think that's one very real implication, very real takeaway. The other real takeaway is that maybe, maybe at some point, this all leads to a breaking point. Not just a bubble bursting moment, but a breaking point for the way the economy operates. And maybe even, dare I say this, the foundation right now is being laid. You could argue it was laid after the great financial crisis. The foundation is being laid for a pivot towards socialism, a pivot away from capitalism. Because to your point, who is most disproportionately impacted by all of these developments? It's young people. I mean, look at the Stanford findings. It's all early career workers, age 22 to 25. Those are the ones that have experienced a 13% relative decline in employment since late 2022. Those are the ones where software jobs have declined 20% since late 2022. Customer service jobs have declined. Sales jobs have declined 20% since late 2022. Those are the ones that we're told to study coding. Those are the ones that are now in six figures worth of debt because they learned how to code and that's no longer valuable. Those are the ones that can't afford a mortgage at all. Those are the ones that can barely afford rent. Those are the ones that are scraping to get by. When you remove the power, both financial and really emotional power of the entire young generation of a society, you could break things in a really potentially bad way. I think there's a reason that New York City, the most expensive city in America, at least I think it's the most, maybe Miami is more expensive in terms of rent to income, but New York City's up there, one of the most expensive cities in America. There's a reason that you are seeing it, some would say, a quasi-socialist pivot in policies over there. with offers of let's let the city support public transportation. Let's have city run or state backed grocery stores. Those ideas are gaining traction over there because you have a lot of young people in that city who just can't afford to live, really. Like, honestly, like, they are living not just paycheck to paycheck, less than paycheck to paycheck. AI is going to accelerate all these issues dramatically. And so, beyond the boom bust cycle of economics, beyond the boom bust cycle of markets, beyond AI stocks, talking about just the societal implications of artificial intelligence, maybe if you fast forward this 10 years, it does lead to a real breaking point where the young generation rebels, if you will, and does show up at voting booths, does show up at polls, and the entire fabric, the DNA of American capitalism changes. I'm not saying that's going to happen. I'm just saying that is a potential pathway forward. Like, absolutely, that is a potential pathway forward. This could be, and if I'm right about that, again, I'm not saying that's going to happen. I'm saying that is a potential pathway forward. But let's say we do go down that pathway, then you really do. If you're looking at markets right now and you think that capitalism as we know it in America ends in the next 10 years, and in those 10 years, 2 to 3 of them will be a boom, and the other 7 to 8 will be a hangover after the crash, then you really only have 2 to 3 years to make money in markets. You see what I'm saying? Like,
Right.
again, I'm not saying this is what is going to happen. I'm just saying if you do the Doctor Strange and look at all the permutations of how things could happen, how things could play out, and this is one of them, and we go down that path, then in that permutation, you have 2 to 3 years to make money in the markets, and that's it. AI with AI. There's a reason I'm pounding the table on it. It's more than just what I'm seeing in the numbers. It's philosophical. It's deep rooted. It's how I feel about things right now. Very deeply. And so, yeah, I mean, this is the stuff that keeps me up at night. This is the stuff I talk about with my wife and my friends, and trying to really figure. I don't have the answers figured out. I'm trying to figure them out. But what I do know is that for right now, we do have a gold rush in markets. That gold rush is going to last. Beyond that, nothing is guaranteed. So capitalize on what is here. Capitalize on the present. Here and now is an AI boom. Capitalize on it. AI with AI.
Yeah, definitely agree that there will be a dramatic shift, or there must be a dramatic shift in the way we do things. Because, I mean, just talking about on a year to year basis, 2 years ago, AI was the thing where you saw funny videos or weird videos of Will Smith eating spaghetti. 2 years after that, we're seeing a nationwide level drop in coding jobs. It's a very pragmatic thing. So what's going to happen in the next 2 years or the 2 years after that? So that is something to really consider. Of course, like you're saying, Luke, you just got to build that moat. But I do want to bring up a question that we got from a subscriber, Keith C, and I think it
Mhm.
does tie into the nature of the conversation we're having, but on a more practical level. I just want to read the question out loud. I thought it was fantastic. He says, I would love to hear more on the energy sector, carbon fueled and renewable energy, technology and electric generation, and how it's going to keep pace with the exponential growth of semiconductor and data center build out and operations. At the same time, keep pace with U.S. carbon footprint reduction responsibilities. There's a lot of folks working on expanding renewable energy storage and ultimately a path to nuclear dominance. But what the fuel source technology is going to bridge that gap over the next 5, 10, 25 years? Is it clean hydrogen growth, or is the expansion somewhere else? Will the advances in this technology reduce the production costs to make it a viable option and still meet the carbon footprint goals in the same time period? Can we really build 3,000 more data centers in 10 years with the current grid? And I thought it was a fantastic question, to kind of highlighting the enormous growth in AI and essentially powering it. What's your thoughts on that, Luke?
Yeah, I would say that, okay, so nuclear is going to be the future energy source of artificial intelligence. At first, it's going to be nuclear fission, then it's going to be nuclear fusion. Um, It does take a while to build nuclear fission reactors. It takes a while to restart nuclear fission reactors. It even takes a while to build SMRs, small modular reactors. So, yes, there is going to be a gap here between where we are currently and the energy demands of artificial intelligence versus when the energy supply from nuclear ramps up to a point to fill that demand. There's going to probably be a 2 to 3 year gap there where nuclear is not filling the supply because it's not there yet. The capacity is not there yet. It takes a while to build these things. What fills that gap, I think, is the question. Um, I don't like this answer, but it's the reality we have. I think it's natural gas. I think
Mm.
natural gas fills that gap because the current administration is very against solar. The current administration is very against wind. Trump has gone on very long rants about how much he does not like windmills. So they're against solar, they're against wind. They haven't really done anything for hydrogen, and hydrogen investment in the private sector is completely drying up. So there's just not a lot of money or support for solar, wind, hydrogen, batteries, etc. And without money or support, I just don't see how those industries grow and fill that gap before nuclear really ramps up. So that's why I think who's going to fill that gap is going to be nat gas. I'm pretty sure some of Tesla's data centers, I think the big Colossus one down in Memphis, I'm pretty sure that's nat gas power. Don't quote me on that, but I'm pretty sure that nat gas powers a lot of that. So I think natural gas is the energy source that fills the gap between where we are now with energy demands and where we will be in the future with energy supply from nuclear.
Gotcha. Which is almost directly opposing reducing that carbon footprint of the U.S., right?
Yeah, I don't think that's a goal anymore.
Right,
No, I
right.
mean, like, seriously, like I don't think that's a go. I don't think reducing carbon footprints is. I mean, maybe the big tech companies can have their goal, but it's not a goal of U.S. policy right now, and it won't be until at least 2028, if not beyond that. So, when I'm again, I try not to play politics or kind of look at things how I would look at things as a father or a human. I'm trying to look at it as, okay, this is the reality I have, and this is the
Mhm.
way I would play it in markets. And the reality we have right now is an administration that hates solar, that hates wind, that hates renewables, is pro nuclear, but it's going to take time for nuclear to ramp up. They definitely want nuclear to be the clean energy source. In the meantime, what's going to fill the gap? The only thing that can fill the gap, given the lack of support everywhere else, is going to be natural gas. So that's just the reality we're dealt. It's against the carbon tax credit stuff, but I mean, kind of like a lot of the other things that have happened in the last decade, that's kind of getting thrown out the window. I think at the current moment, at least, it probably makes a comeback at some point in the next 5 to 10 years. But for the next 2 to 3 years, it's dead and gone. So yeah, nat gas is going to fill the gap.
Gotcha. And I think a little bit of coal mining, I believe there was some executive orders to reactivate that as well.
Yeah, yeah. So again, it's going to be your old school stuff.
Right.
Oil, gas, coal. Like it's going to be your old stuff. Your old stuff is going to be the stuff that's going to make a comeback to fill that gap until nuclear ramps up. But then again, I think that gets obsoleted by nuclear. Like this administration is very pro nuclear. Nuclear is the right answer based on the numbers and the data. So we are going to get to a point of nuclear supremacy, nuclear dominance. But it will take time to get there. In the meantime, you'll have nat gas and coal and oil fill the gap. But the reason you're not seeing those stocks really soar, some of them are, but the reason you're not seeing a lot of them soar is because investors, I think, largely understand it's just a short window for them. This is not a long-term growth story. It's a short window until nuclear ramps up. It seems very clear the writings on the wall that nuclear is the future of AI power.
Got it. So almost a holdover until we can get that next big thing.
Yes, that's the best way to put it. Exactly.
Gotcha. Okay. Now, speaking of power, I did want to move on to the last subject. A stock we haven't really talked about, but that might be a great fit for the boom in the exponential tech is Enovix. I want to get your thoughts on that particular stock, Luke.
Yeah, Enovix. I like Enovix a lot. The stock has been disappointing in terms of price action. They had a really big announcement last week. I think that maybe could get the stock going. But the story here is that they are essentially a better battery maker. Um, Batteries today, we're talking kind of small format batteries like smartphone batteries, smart glasses batteries, etc. They use graphite. Now graphite is less good at storing energy than silicon. So you can either use graphite or silicon in a battery to store the energy. Silicon is scientifically better. It can hold way more energy. But graphite is used because silicon swells. It when it's charging, it swells and then it cracks and the whole battery kind of blows up or bursts. So that's why graphite's been the go-to material for small format batteries for a very long time now. Enovix has kind of figured a way around that. They have a 100% silicon battery. And they've done it to avoid cracking. So they've created a battery that has silicon that doesn't crack. They do it through a few cool kind of gimmicks. But what they basically have done is they have this special design in the battery that locks the silicon in place so that it doesn't balloon up and break when it's charging. It's kind of locked. Really complicated. Don't need to explain it in
Right.
depth here. But what's important to know is that one, as opposed to sort of, batteries kind of like they look like the circles, right? They kind of wrap, the stuff wraps around it, right? When you think about a AA battery or AAA
Yeah.
battery, it all kind of wraps into the cylinder. They have more like a line approach. And with the line approach, they kind of lock the silicon in there. And so it doesn't expand. But the more important thing there is that it's very defensible. I mean, they have patented the heck out of this thing. They're the only ones that can do this. So they've created this battery. Supposedly, now because it has silicon and it's opposed to graphite, it should be a better battery for smartphones, a better battery for smart glasses, a better battery for iPads and computers and things like that. Well, last week, the big data that they showed, let me get the exact numbers for you so I'm not repeating bad information. They got independent testing on these batteries, and it was pretty fantastic. So they have their AI1 battery, is what it's called, and it's a battery built for why it has AI in it. It's an AI battery, right? It's a
Mhm.
battery meant for AI devices because a big kind of choke point in this industry is that we want AI to move to the edge. We want AI to be embedded into our devices. We want holographic AI experiences talking about smart glasses and things like that. But that requires a better battery because that's a lot more power usage for these devices. So we need a better battery to power these AI devices, hence them calling it the A1 battery. Well, last week's data sort of shows that maybe Enovix did crack the code here. So the charge times is the big thing to pay attention to here. They reported that you can get a 20% on a smartphone, a 20% charge in less than 4 minutes. You can get a 50% charge in about 12 minutes, and you can get a 100% charge in about 40 minutes. Now, compare that to your standard iPhone charge time 20% in 10 minutes, 50% in 30 minutes, and 100% in 90 minutes. So
Wow.
they broadly cut charging times in half. 20% charge, current 10 minutes, they're down below 4. 50% charge, current 30 minutes, they're down below 12, or right around 12. 100% charge, current about 90 minutes, hour and a half, they've cut it down to 40 minutes, less than an hour. So they broadly reduced charging times across the spectrum by 50 to 60, 65%. That's pretty impressive. To me, that's breakthrough like that is something that could, okay, if this data is legit and it was independent testing, if they ship these samples off to Apple and Samsung and Meta, why on earth would Apple, okay, you're telling me you got a battery that can charge this thing 50% faster, why on earth would Apple not want to put it in every single one of these smartphones? Why on earth would they not want Meta not want to put it in every single one of these smart glasses? They would. So if this data is legit, and we're going to find out in the next few months if it is legit, because Enovix is indeed shipping samples of the AI1 battery out to folks. If it's legit, those companies independently test it. Meta independently tests it and sees, wow, this does reduce charging time by 50%. Apple does it. Wow, it does reduce charging time by 50 to 60%. Then guess what's going to happen in the next few quarters by early, probably summer 2026? You're going to get big contract from Meta, big contract from Samsung, big contract from Apple, and all of a sudden, Enovix is the go-to supplier for batteries in the AI consumer technology device era. That is a very valuable proposition for a company whose market cap is, what's the market cap on this puppy right now? Let's see. So Enovix has, a $2 billion market cap, which looks expensive relative to its, what the estimated revenues this year are $33 million. But I mean, you get a contract from Samsung, you get a contract from Meta, you get a contract from Apple, and all of a sudden that $33 million in revenue swells to potentially several billions of dollars in revenue, right? I mean, look at the estimates here. We're going from 33 million in 2025 to 102 million in 26 to 345 million in 27 to 824 million in 28 to 1.7 billion in 2029. And given the data we got last week from the AI1 battery, I think you could be upwards of $2 billion in sales by 2029 if you get these big contracts again from Meta, Samsung, Apple, etc. Stock like this could easily trade at 10 times sales. So you got a 2 billion sales total in 2029. You put a 10x revenue multiple on that. You're talking about a $20 billion market cap. We're at 1.8 right now. There's your 10xer. There's your 10, 11, 12xer on a Enovix stock over the next 4 years. I do like this one as a long-term call it AI battery play, right? Not in the sense that they're making AI powered batteries, but in the sense that they are making batteries for the age of AI. As AI becomes embedded in physical devices, we need a better battery, and Enovix has made that better battery. If indeed Meta, Apple, Samsung, and other physical AI device makers recognize that and then turn them into their supplier, boom. It's a 10x. So yes, I do like Enovix stock for its long-term potential, absolutely.
So I hate to be a Debbie Downer here, Luke. We were just talking about an impending or potentially upcoming AI boom. Does Enovix have enough fundamentals? Is its thesis strong enough to power through an AI crash?
I would say that yes. I mean, if indeed you do get a contract with Meta and Samsung and all those big boys over the next 12 to 24 months, and even if the market does crash in 36 months, I think the stock can weather through that because of the ramp of the individual story. Now, again, I'm not looking at anything from the lens of I'm not what I'm not doing is saying I'm not going to buy this stock today because I think in 24 months it may crash. I think that is the dumbest thing you could do right now. I think that is absolutely dumb to say I'm not going to buy stocks right now because I think the market's going to crash in 1 to 2 years. No, like that's not what you want to do at all. You want to buy stocks now because you think they're going to rise over the next 1 to 2 years. Yes, I do think there's going to be a bubble and then we do burst, but that doesn't mean, again, a lot of money is going to be made over the next 1 to 2 years as this bubble gets into burst territory. We're not in burst territory right now. So I'm not making any decisions based off of what I think is going to happen in 2 to 3 years. I'm making decisions based off what I think is going to happen in the next 12 to 24 months. And I think it's green shoots, big rally, lots of gains, lots of wealth creation for the capital class. I want to be a part of that party. Then when we get to the bridge of, oh, this got too far, we went too far out on our skis, then we'll deal with it. But for now, let's enjoy the party. I think Enovix can be a big winner in that party.
Roger that. Okay. Now I do want to move on to rapid fire exponential stocks here. I want to pick it up with Snowflake.
Yeah, so I think a lot of our stocks this week we talked about fundamentally because just we talked about the earnings. The earnings were great and the stocks are blasting higher. So now let's look at a couple of these stocks from a technical perspective. So here you got Snowflake. You can see the massive jump right there on the stock. We'll just get the volume out. We'll put the RSI in so you can see how overbought it is. But what I like about this one a lot is obviously we have the MAs all turning higher. That 200-day finally a real positive slope, first time since back in 22. But I really, really like the takeout. Well, what I would really, really like is a takeout at this level right here. That would be a wonderful takeout. And we did kind of take it out, 236, right? We took it out, we lost at 233. We did indeed, you can see, we got to 241. We took out 236. That's not just the high from there, that's the high from all the way back here, okay? This sort of 240 level, that was a peak back in early 22. It's been stuck below it for a long time. Now we're hitting our head on it. I would love to see a break above 240, a hold above 240, 240 turns into the floor, and then we have runway up to these levels, back up to 400. I do think the stock is going to get there in the next 12 months. I think this $230 stock turns into a $400 stock by summer of 26. This one to me, that is a great looking breakout. Boom, clear this. We stay on that trend. We're up to 400 by the summer of 26. I like snow quite a bit.
Awesome. Okay, next up we got MongoDB.
MongoDB, another databasing company, more for kind of fluid data, if you will. This one is one that has been struggling to prove itself to be a winner in the AI boom. As you can see, look, I mean, this was the lows of that tech crash in 2022. Looked like it was going to be an AI winner. Nope, just kidding. Revisited the lows of 2022, essentially right around 150. And now we're bouncing higher. Got a good earnings report that said, you know what, maybe, just maybe, we are turning into an AI winner. I do think this is an AI winner. I think there is a story here for databasing solutions. I like the bounce off that 150 support from the inflation crash of 2022 lows. I like the fact that we retook the 200-day moving average. I do like the fact that we've broken this, you know, if you kind of look at this downtrend right there, that was a pretty significant downtrend. Hit our head, boom, clearly blasted above that. So this downtrend to me is over. Now I think we're cycling. So if you kind of look at the chart in this manner, right, this is how I'm going to look at the chart. I see it as this. Let me get my swing line. Here you go. Boom. Peak here in 21. Big crash to 150. Big rally up to 500. Big crash down to 150. Now I think we got a big rally up to this. Kind of got in my way here. Boom. Getting good. Sees. Let's get this out of my way. Boom. And then we rally back up to 500. Right? This to me is like a sinusoidal wave. Boom. Big peak, big crash, big rally, big crash, big rally. I think we're here now, boom, in the process of doing another up wave to $500. I think MongoDB has a great runway over the next 12 months.
Gotcha. I just have to ask, I can understand the 2022 dip, but what was the reason for the most recent dip there in MongoDB?
Because their numbers weren't improving in the way that you thought they should with the AI boom, right? Again, the whole bull thesis was their databasing layer for the AI boom. So is AI the same thing about Snowflake. As AI applications increase in usage and for volume, then you should get more data, more need for databasing solutions. And MongoDB's growth rates were not accelerating in the manner that was consistent with that thesis. Now they are. The most recent report showed that they are indeed accelerating in a manner consistent with the thesis. So the thesis that drove this rally from 150 to 500 is now all of a sudden coming back to life, and that's why I think you can drive another rally from 150 to 500. So that's sort of what I'm getting at there.
Gotcha. Okay. And then one we talked about a little bit earlier today was Pure Storage.
Yeah, PSTG, I like the chart here too. I like the story. We talked about the fundamental story. I think it's a good fundamental story. I think the stock looks pretty as well, the chart that is. Let me zoom it out here. So this is one that's been on an uptrend for a long time. Really didn't have much of a tech crash in 2022, as you can see. Let's go from those COVID lows, kind of a pretty steady uptrend ever since then. The one concern was that we kind of, not a double top, but it looked like we were maybe this is kind of a topping pattern. They weren't really making new highs, made new lows, tried to recover, but didn't really get back to these levels. And then we had this straight line zoom on earnings, right? That's a super critical technical break above not just the 24 highs, but the early 25 highs. Now we're making real meaningful new highs. 200 starting to slope higher again. The 50 and 100 picking up action. Of course, the short-term RSI is way too high. We are way too extended in the short term, but the uptrend here is very much alive and well. And I do think this stock does push higher from here. Fundamentals look good. Growth looks good. Valuation's reasonable. Chart is pretty. This one, in my opinion, has a good runway over the next 12 months.
Fantastic. Next up, we got OfferPad Solutions.
OPAD. We've talked a lot about Open Door. We haven't talked all about OfferPad. OfferPad is Open Door's ugly little brother. And it's always been Open Door's ugly little brother. We've seen the long-term Open Door chart. This one's uglier. This one had a SPAC around $10, but then they did the split. I think it was 15 to 1 or something. I don't know. So it's gone from essentially 150 down to 90 cents. Now it's up to $5. So now let's zoom into what's going on here. Okay, boom. There's the Open Door rally, big straight vertical, basically buck to, what was it? Peak was 620, now we're down to 5. Do I like this one? Well, if you look at it kind of from a log format, we are taking out some pretty critical technical levels, but we're pausing right around these lows. There's a series of lows here from 2023, right? This stock absolutely crashed in 21, even 21 and 22, all the way down to 23, and it found a floor around $6.24 before giving up that floor in the second half of 24 and 25. So now we're back to that floor. We are not retaking that floor. That is technically bearish. In the same way that we talked about how Open Door hope got it from 50 effort, rather got it from 50 cents to $5. Now execution has to take it from 5 to 40. That's why we're pausing at 5. OfferPad, similar pattern. Hope, effort. There's not even really effort here. It's just kind of, I guess you could just say it's just getting thrown in the same bucket as Open Door. With that big first leg of the Open Door rally, it got up to major resistance, and now it's pausing at major resistance. If Open Door now executes and goes higher from 5 to 40, this one will too, because they're kind of tied together. Not in the sense that what Open Door is doing is what OfferPad is doing, but in the sense that the market is just throwing them in the same bucket, in the same risk category, if you will. So I like Open Door way more than OfferPad. I wouldn't mess around in OfferPad, but if you're looking for more leverage, you're looking for a kind of extra juice to that rally, you do think Open Door can get from 5 to 40, then OfferPad probably goes from 6 to, I don't know, maybe 60. I mean, like it could go higher than Open Door in a everything goes right scenario. But again, I like Open Door better. The fundamental story is actually there. OfferPad just kind of feels like maybe a 2 times levered ETF on Open Door, more or less.
Gotcha. This is one of those a dollar and a dream stocks.
That is exactly right.
All right. And then finally, we got EchoStar.
Yeah, EchoStar, it got a big bounce because I think AT&T is buying some of their assets. The stock's been kind of stuck for, I mean, decades, really. Not much of a comment on this one, even if I go to the weekly chart. It's just, I mean, it's a stock that's been stuck for a very, very long time. AT&T is buying some assets. So the stock's coming to life a little bit, but I mean, it's cyclical. It probably peaks out pretty soon, and then we come back down after the assets are bought. So cool rally. If you saw it coming, congratulations. All power to you. This one's gone from 20 to 60 in a heartbeat. So fantastic. But yeah, I'm not seeing much reason to really get excited about a secular growth story on this one, either from the chart or from the fundamentals.
Gotcha. Yeah, I think I remember hearing about that when they were holding on to a certain part of the spectrum. It was a cool tech story. They had their assets were just waves that AT&T were buying essentially.
Yeah, that's exactly what's going on here. So again, cool story. If you saw it coming and you got to play it, wow, good for you. $10 to $60 since the summer of 23 or since late 23. Great stuff. But now that that deal has been announced, now that it's happening, I don't see much reason for further upside, technically or fundamentally, in the stock.
All right. Good stuff. And that wraps up the episode for this week. Luke, I got to ask again, is there anything you think we might have missed that we haven't talked about this episode?
We covered a lot of ground. I want to talk about humanoids next week because Musk did tweet, I think, while we were having this podcast about how it's going to drive 80% of the value. So I definitely want to touch on that next week. But no, I mean, we covered the big topics. And I am, again, it's just, we're in this very weird moment where the AI boom is creating so much wealth in the capital class and destroying so much wealth in the labor class. Again, the microcosm of Salesforce, 4,000 jobs lost for the labor class, $110 billion in wealth created for the capital class. That's a microcosm of what, if it's not already happening, will happen at every company in America over the next 2 to 3 years. That's going to create, again, a lot of wealth for the capital class, but it's going to create so much frustration in the labor class that eventually the two sides will have a breaking point. And that's probably going to contribute to when this AI boom turns into a bust. But again, do not let that dour, maybe pessimistic long term or medium term outlook on things cloud or disallow you the opportunity to make a lot of money in AI stocks while the AI boom is very much alive and well, because it still is very much alive and well. The ball game will end, but I think we're in the sixth or seventh inning, and I think the seventh, eighth, and ninth innings will be the best innings of the ball game. So play ball, folks.
All right, agreed. Yeah, I think a lot of the surveys say healthcare is still the safest sector, but not everybody can be a nurse. So definitely play ball, get in the market, build your moat, stay safe. That's been another week of Being Exponential. We hope to see you next week. And again, just a reminder, send in those questions. We want to make this a conversation. We want to make this a community. But that's all for this week, and take care.